We're back home now and returning to our coverage of this afternoon's interest rate decision. Joining us live is ANZ Economist Adelaide Timbrell. Adelaide, good to see you. Thanks for your time. Where do you stand on this? Where are you thinking that rates will be landing today?
I do think that we will see a rate hike. That's the ANZ research call, and it seems to be an increasingly popular call among forecasters. The latest CPI data showed inflation sitting uncomfortably high, particularly when we compare it with the Reserve Bank's August economic outlook, where they thought that inflation might get down to 4.1% by the end of the year. That's very unlikely now. We also know that in their latest minutes of the October meeting, they said that they have a low tolerance for divergence of inflation from their expected path. So if they're not expecting it to get to their path and they've got a low tolerance for that, that kind of adds up to a rate hike.
Okay, and then could we see another one before Christmas? And then more broadly, what sort of environment are we looking at next year? Do you have any positive news for all those mortgage holders out there?
Well, look, currently we do think that the November hike is more likely to be the last, and then we should see a bit of a break from further hikes. Now, that's not guaranteed, particularly if inflation continues to disappoint. But the good news is that we are forecasting the start of the easing cycle in late 2024. By then, by kind of late next year, we should see enough evidence of inflation getting back under control that mortgage holders can get a bit of a relief from those high interest rates. We also think that wage growth will accelerate next year a little bit too, which means that the average person will be paid a little bit more, they'll have a little bit less on the mortgage side, and see prices rising less as well. So 2024 should be a better year unless there is that, secondary rate hike after November.
Adelaide, whatever happened to that much warned about mortgage cliff? We were told that thousands of mortgage holders would be falling over that cliff. Did most go over? Did they have their parachutes? Did they land okay? How did it end up, or are we still seeing that play out?
Look, households have been incredibly resilient to the increase in mortgage payments. So we know the average mortgage based on Reserve Bank analysis is up by 30 to 50%. But it does seem that most people can pay, not without pain, not without a change in lifestyle, but it can be done. So part of that is because of all of the huge savings buffers that many people built up during COVID. Part of it is that people have more hours or a higher paying job than they did before. And part of it is that there's these bigger offset balances, which are taking some of the intensity out of the interest payments that are coming up on those mortgages. We also still have some people on fixed rates as well. And the people coming off fixed rates have had the biggest opportunity out of everyone to prepare for this high interest rate environment. Because while everyone was going 2, 3, 4, 5, 6, they were sitting down there at the twos, biding their time and hopefully saving along the way. Arrears rates are still low. Most people are still paying their mortgages, again, not without pain or a lifestyle change.
Okay, so when we look at the property sector, we've just seen some fresh data out today, I think it was, setting fresh record highs when it comes to the property sector. Why haven't those interest rate hikes done anything to dampen that?
Yeah, it's been a really interesting dynamic in residential property. We did see property prices come down around 9% as rates were going up, but then they've pretty much bounced back since then. They've been up 7.6% since January. Now, what this comes down to is a shortage of supply. So yes, everyone has less borrowing capacity, but there are actually a lot more people looking for homes. The average person wants a bit more space, particularly if they do have a hybrid working model for themselves. And so we're seeing a lot of pressure put on supply. On the other side of it, we're seeing property developers do not want to build. Building approvals in the residential sector in Australia are at a decade low. And that's because when you think about the higher costs of funding, the higher cost of construction, materials and labour, and then you offset that against the higher prices, those prices actually aren't high enough to lure developers back into that sector. They're looking at the construction costs, they're looking at the building sector insolvencies and going, that's a bit too much risk and a bit too much tied up money for me in this high interest rate environment. I just don't want to build. Apartments in particular are suffering from that kind of maths issue. So we're seeing that because there are so many people looking for homes, it's really, really hard to find a rental. That's also pushing prospective buyers into the market. That's outweighing some of the interest rate downward pressure on housing prices. And in fact, housing prices are not only rising, they're accelerating.